This economy contracting for the first time since at least 1992, a big contraction, more than what was anticipated by the economists. What's your instant reaction?
Well, let me be clear. The first quarter contraction is not a surprise, considering the nationwide lockdown in late January and February. But sequentially, the March industrial output you just mentioned and their trade data suggested that the supply side in the Chinese economy has been on a recovery path. So I think they are first in, first out amid this great COVID-19 recession. It has seen the worst in the first quarter, followed by a relatively shallow U-shaped recovery from second quarter onwards. The IP data, which is better than their retail sales or other domestic demand data, means its supply side has been largely normalized, with now 90% of factories in China are fully operational. 80% of service are also back online. That's why we see activity improving on the IP front with largely normalized supply. But I think the bottleneck for recovery in the next stage has shifted to the demand side, as lockdown in China has been replaced by softer social distancing measures, which means people returned to work but not hanging out. That's why you see this deep contraction in retail sales, which kept the pace of consumption recovery. And there is headwinds like external demand shock, as most other major economies are still in the lockdown stage. As a result, growth in the rebound in the second quarter were likely to be shallow, just marginally above zero. But it could accelerate more meaningfully in the second half if we have improvement in consumer behaviors and also external demand. Yeah.
Well, tell me something here, Robin. We've got also fixed asset investment coming in also weaker than anticipated, just over 16% decline. We were looking at 15% drop back with regards to that one. So, Robin, that doesn't bode well looking ahead, does it?
Yeah, that's why we do expect more policy stimulus. In fact, we expect $800 billion COVID-19 economic relief package from China. Half of this $800 billion will be fiscal deficit expansion, and the other half will be quota fiscal credit measures like targeting these affected sectors. In turn, that could boost their infrastructure capex growth from 3 to 4% last year to something close to 10%. And if you think about the sequence of their policy, up until now, they have been relatively shy on direct support measures for corporates or households. That's probably because the NPC has been delayed, and the new central government special bond, which is used to fund all these supplementary budget, won't be confirmed until NPC. But ahead of the NPC, we think Beijing will focus on infrastructure first to fill the gap left by this lagging consumption recovery and weak exports. They can front-load the local government special purpose bond ahead of NPC. So that's what we are expecting. $800 billion package is on the way, and they will front-load the infrastructure part of it. Yeah.
Robin, just taking a look at the market reaction, China's 10-year government bond futures extending its loss after those GDP numbers and the rest of the data. I want to bring your attention to retail sales. March retail sales falling almost 16% year on year versus estimates of 10%. I mean, what assumptions are you making about the return of consumption here? Because that is pretty much the backbone of the economy as well.
Yes, that's a very important factor of this COVID-19 shock. Basically, the recovery is easier on the supply side. For example, our survey showed 90% of factories in China are fully operational, but the recovery in consumer behaviors will be far lagging because of there is a continued softer, but still social distancing guidelines everywhere in China. If you go to coffee shop, hot pot places, there is a rule about one person, one table, and the distance between each tables, and the cinemas are still suspended. So a lot of these measures is probably the new normal in near term before vaccine becoming broadly available. So that means social distancing economy, it is the new normal for 2020. That's also one reason we are not expecting a quick or sharp turnaround in the Chinese economy, instead just a relatively shallow U-shaped recovery from second quarter, because the pace of recovery in the consumption sector will be capped by these social distancing guidelines. Having said that, we still believe it's gradually getting better. We have something called Alpha-Wise weekly survey on the consumer behaviors in China based on more than 2,000 consumers once every week. And they are gradually going out more often, spending on discretionary spendings in the shopping malls. So week on week, it's getting better. We think by end of second quarter, most of the social distancing guidelines could be relaxed, and by end of third quarter, the consumer behavior may back to normal in China.
Robin, taking a look at the reaction in the equity markets, the CSI up by more than 1%, pretty much brushing off those worse than expected numbers. It does seem like the market has factored all of that in. Now, taking that into consideration, would this be a catalyst for bigger stimulus from China or not?
Yeah, we do expect a stimulus, as I mentioned. And the risk is the consumption recovery has been lagging, and you have strong headwinds from external demand. So the job market in China is definitely facing some near-term pressures. Our survey shows that if you have an operational capacity of 90% in industrial sector and 80% in the service sector, basically you have 80 million unemployed due to business suspension at this moment, and potentially another 100 million underemployed. Underemployed means they are working part-time or fewer hours than they desire due to insufficient demand amid external demand shock and the social distancing guidelines. That's a quick and meaningful relief package we mentioned earlier in need. And if you look at the PBOC rate cut, we do expect them to deliver the LPR rate cuts, probably 15 to 20 basic points next week, largely in line with the open market operation rate. And after that, we expect another 20 basic points OMO rate cut in May. Having said that, I believe the PBOC move on rate cuts would not be the major role. It could only play a relatively minor role in this stimulus package. That's because a large portion of... Yep, go ahead.
Robert, just very quickly, let me just ask you one question, which is, how does the data look ahead, given that this reflects, as Hasina put it, it's looking in the rear-view mirror, but if we get your crystal ball out, these numbers were when China was in lockdown. China's opening up again when the rest of the world is locked down. What impact does that have on the numbers in the future?
Yes, we think for the second quarter, the recovery will be initially quite soft. We think it will be just going into expansion territory with slightly above 0% year-over-year growth. It's largely driven by recovery in the supply side, in the infrastructure capex, but on retail sales and the consumer, it will be still far lagging. By second half of this year, if we have more improvement in global demand and these social distancing guidelines got relaxed, we will have more meaningful growth recovery to around 5% in third quarter and around 6%. Yeah, Robin, that's their potential growth.
Robert, just very quickly, actually what we did get was we got a correction coming through at the moment that actually industrial production wasn't positive. It actually declined by 1.1%. I'm guessing that's still much better than expected because you're looking at 6.2%, but I'm guessing that doesn't move the needle for you much, does it?
No. The direction is basically the same. The recovery in supply side, the industrial sector, is better than the consumer side. But now the bottleneck has shifted from supply side to the demand side.